Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. Global equities witness a sell-off as US President Donald Trump signals he's willing to wait for another year to strike a trade agreement with China. S&P reaffirms India's sovereign credit rating at BBB- with a stable outlook. The centre looks to review GST compensation cess and rates to boost revenue from indirect taxes. That is according to a government official. NBCC and Suraksha Realty offer more land parcels to lenders in their final bids to acquire JP Infratech through the insolvency process, reports PTI. In HDFC Bank, customers face technical glitches for a second straight day. Some of them have been unable to access net banking services. On last count, those services seem to have started resume. Okay, let's take a look at the trade setup for the day. Remember, trade risks are back and firmly in the stable, and that is leading to the world markets doing what they did. So the US markets haven't quite done well in trade yesterday either. Second day on a trot, the US markets have looked very, very wobbly. And by the way, the yields too, while they have paired a little bit of gains, you've seen what's happened. That the classic risk-off out there in the US markets, or at least the start of a risk-off. And this is the reason why. One, of course, the trade war conversations, and two, as a result of that, the impact on stocks as well as bond prices, and both of them have changed. Now, the question is, what do experts make of this? Let's first get in an expert to talk about this, and then we'll talk about what's happened to the world markets and the Asian markets and what could happen to India as well. Gavin Parry, Managing Director at Parry Global Group, joins us right now to talk about this. Gavin, good having you. Thanks much for joining in.
Morning.
I can throw 10 different types of data and slice and dice to show whether the markets will brave this or not. But my question is this: with Donald Trump saying that he doesn't mind extending the trade deal until after the elections, are we in a hibernation period, or are these negotiating tactics before the December 15 deadline? What do you think?
Well, look, I think this just really comes back to something we spoke about on this program, earlier this year and late last year, and that is that volatility is something that we definitely see increasing. I think underlying for markets, we need to keep in perspective that we're still seeing fairly decent stability in relation to macro data. I mean, you've still got one of the lowest unemployment rates in the US. You still have a fairly easy stance in relation to monetary policy. So therefore, we still see these markets in upward trend, but there's definitely quite a larger element of volatility here. And so it's these kind of headlines which are, let's say, non-economic. They're more political in their origin, that are definitely going to be drivers for the volatility that we're seeing increase, let's say, coming in here off the back of these things.
Well, December typically is a low institutional activity month, Gavin.
Correct.
Do you reckon this time could be different because of, one, the news flow and the slight risk-off that we are seemingly entering into, and the fact that December 15 is that key deadline?
Yes. Well, there's a couple of factors at play here. Obviously, the comments that you just reiterated there, that the Trump administration, with President Trump saying, look, he's quite happy to wait until the 2020 elections is one aspect here. The other aspect that you've just pointedly pointed out is that we're hurtling towards that planned increase of current tariffs for the 15th of December. I think the other element here that we really do need to keep into the mix, physically into the mix of considerations, is that the rallies that we have seen, particularly for cash equities on market asset equity prices, has been very much a Trump effect, and it's in the background, the kind of impeachment aspects that are still swirling around. I think you need to also bring this into the mix in relation to the variables that are coming from an uncertainty on the trade situation, because the market will also increase volatility here if there's seen any perchance that, for example, coming into that election period, whether it's the trade impasse or whether it's in relation to these impeachments, has a negative impact for him to actually win the next election. One of the main aspects we've got to remember here is that 70% of US GDP is a factor of consumption. So therefore, household balance sheets and the wealth effect there has a direct impact in relation to these equity markets, in relation to skewing the propensity to save to that of consume. And so therefore, it's that underlying sentiment that the Trump rally, let's say, in cash equity markets will continue or hypothetically have a probability of not continuing that's really going to be the sentiment driver as to how these markets continue and again, what the volatility impact of these markets are going to be.
So, Gavin, if you assess all of these, do you reckon in your mind that this could well be a tactic of negotiation? I mean, day before yesterday or yesterday, Donald Trump went ahead and imposed those restrictions on imports from the two Latin American countries as well. So he's trying to show that he means business in order to do precisely what you said, posturing. Yep. Do you reckon December 15th could well see a deal getting stuck, or rather, the period before December 15th could well see a deal getting stuck?
Well, if we had a crystal ball, we wouldn't be sitting here.
I'm just working with. I'm just asking you, how would you approach your investing or trading on the back
on the basis of probability?
Yes.
You have to assume that if there is no rigidity or solidifying of policy in relation to this current impasse, that if we came to the 15th, that those increases would come to pass. You'd have to, on the basis of probability, assume that. Your comments about internationally, obviously the last 2 days we've had comments out of the Trump administration about France as well. So, and the fact that they're looking at a digital tax which would impact America Inc. within the French scope of things, and obviously Trump saying here, well, look, we can easily put a tariff against France for their imports into America as well. So this is not just a Sino-centric, let's say, aspect. It's very much a nationalistic or American-focused aspect of trying to get the best deal possible for America on the global sphere of things, not just, as I mentioned, from a Sino aspect.
Okay, Gavin. Understandably, your points taken on board. Thank you so much for taking the time out and speaking to us today.
Thank you. Bye-bye.
A bit of a risk off for sure, as that chart indicated. Gavin Parry saying that he would presume that the tariffs would come to pass. Let's wait and watch. There are enough and more articles on Bloomberg and BloombergQuint.com which are talking about what could happen if indeed the tariffs come back. So do log on to both the websites and try and read more about them as well. But the moot point is that there's a bit of a risk off right now, as one of the charts suggested. And frankly, for the emerging markets too, if you just look at the risk off factors, there is a very interesting chart that I just want to mark before I move full tilt towards India. And that chart is this one. Now, what does this chart indicate? There are two indices that it is trying to point out. One is the CBOE emerging market ETF volatility, which is the white line, and then the JP Morgan Asia Currency Index, both of which are Asia denominated. One is the currency index, one is the ETF volatility index. And both of them, as you can see, are choppy and have a bit of a downward bias in the recent past. So if people thought that emerging markets were moving up and therefore they were a bit more safe compared to the US markets of late, I don't think that is the case. And frankly, for our markets as well, that is essentially the trade setup, global in Asia in nature. The Asian screen is awash with red. We may be sure, look at that. I mean, Nikkei down about 1.5%, Hang Seng down about 1%, Australia, Kospi, all of those indices have a red tick. And the SGX Nifty indicates a start, which is marginally lower in trade, about 1/3%. But we might well have some more downticks if indeed we start below 12,000 and then stay below that for a while. It'll be very interesting to see. Yesterday, banks led the charge, but you never know. In today's session, it could be the non-banking stocks that could correct as well, because frankly, if you look at both the indices, which is the Nifty and the Nifty Bank, we are substantial points away from key support levels for either of the two indices. So let's wait and watch what happens in the session today. Difficult. We'll start off in the red. The question is what will happen to individual stocks. Then that's something that we can probably predict with a bit more authority. And here are the 3 or 4 names that I believe we should watch out for very quickly. HDFC AMC, promoter Standard Life Investments has proposed to sell about 47.5 lakh shares, which is about 2.23%. And maybe an additional 38.5 lakh shares of 1.8% as well, the option that they have. The floor price is important, 3170 per share, which is a discount of 8%. Now, keep in mind, when SBI Life and HDFC Life in particular saw this selling. Immediately the stock bounced back. The question is how soon the selling in this one gets absorbed, and can it bounce back from those lower levels if indeed it goes down. So watch out. Arguably one of the more important stocks, even though the OFS is not as large. Bajaj Finance, all the maths that we did suggested that the exposure will not be very high. Now yesterday we have the company's official statement saying the current exposure to Carvi is about 312 crores. It's not a large percentage of the overall AUM, but it is 4.3% of the total loan against shares portfolio. Yesterday the stock recovered a little bit. Let's see if it manages to do that or comes under a bit of pressure today. ICICI Bank has held an analyst day after nearly a decade, and the management spoke about the focus on profitable growth, the focus on ROE, and a partnership model that they want to get out. So watch out for this one as well. Brokerages by and large have been very, very bullish post this analyst meet. So do watch out. I think the management focus on profitable growth and the ROE is something that stuck well with people, with the brokerage community. Then Crompton Greaves consumer block deal. The buyers is interesting. SocGen, SBI Mutual Fund and Amundi are the three that have bought into, so watch out for this one. And lastly, a listing today, CSB Bank, the base price of 195 per share. The issue was subscribed 87 times. Be an interesting one to watch out at 10 a.m. Let's tell you what's lined up on First Word today, the top editorial stories that we want to bring to you. Yes Bank entered the F&O ban. Navneet Saluja Johnson to tell us why it shouldn't surprise anybody and what could happen next. Chef Ali Malik will then bring us the takeaways from the ICICI Bank analyst meet. Nikunj Ori will then join in to tell us about the centre's SOS to states over GST. And then Nikki Mirchandani rounds up with a closer look at what's driving the rally in the stock price of Tube Investments. Yes Bank stock dropped nearly 8% in trade yesterday after 23 lakh shares traded in a single block, and the activity in the derivative space pushed the stock in the F&O ban. Now Navneet Johnson to talk about the futures and options data on the stock, and Navneet, why it shouldn't surprise too many people that the stock is in a ban.
Well, if you would have looked at the data yesterday or day before yesterday's data on closing, already the open interest was 91% of the market-wide position limit that we see for for all the F&O stocks. So for a stock to enter into the F&O ban, remember the total open interest, that's across futures and options, it has to cross the 95% mark, and that exactly happened yesterday. There was a lot of trading activity happening on the F&O front. So yesterday, as of close, the total open interest was about 99% as a percentage of MWPL. So when does the stock come out of the F&O ban? That's a big question. When the total open interest will fall below the 80%, and that will only happen when the existing trades starts to get unwound by the traders who are already sitting with their position. So what does the F&O ban exactly means? You can definitely trade in the F&O market, but that has to be only intraday trading. If you're unable to close your position, if you tend to roll over, your brokers and the exchange will ask you to pay a penalty for the same. But looking at the futures and options data, we highlighted yesterday that the Yes Bank futures were trading at a discount. So yesterday's closing discount was also about 3 rupees. And if you look at the open interest in the last two sessions, why I'm taking last 2 days, because you did get the news of fundraising post closing on Friday, and since then we've only seen negative reaction coming in for stocks. So stocks down 13% since the time that news has come. Open interest on the futures has gone up by 8%, clearly telling you fresh shorting is coming in after the news is already come out in the market and priced. And of course, most of the brokerage notes highlighting how the investing community will now be wary of the quality of investors coming on board. What's the level now you can watch out? So maximum open interest on the option side, on the call side, is at 70 and 100 strike. If you look at the put strikes, it's 60 as well as 70. And what we saw yesterday was majority of call writing coming in at strikes like 60, 65. We've already breached that mark of 60 in yesterday's trading session, and 50 put saw major unwinding, and that was pretty surprising, because if somebody has written the 50 put, that person is expecting that the stock will not fall below that level, but that already happened in yesterday's trade. So support, I believe, could come in at 50 level. That's the key level to be watched out on the downside. And just looking at the cash activity also, Neeraj, the volumes which was seen on October 31st, when the news came in around 1 p.m. that they are looking at fundraising, they'll have a board meeting in the month of December. Even that day, the delivery data was just 12% of the traded quantity. That's telling you this is more of speculative trading. On majority of the days since then and before that, your delivery has been only sub 20%, giving you a clear indication it's a high beta counter. The margins volumes on the stock futures has risen to nearly 50%. So brokers too are wary if somebody is trading into it, that pay us higher margins because the stock tend to give you that wild moves.
And I reckon there will be significant unwinding necessary for the stock to come out of the ban as well. It doesn't seem like, unless there is heightened activity, it will be out of a ban in a hurry.
Yep, as I mentioned, it has to fall below the 80%, so it will take some time. So I don't know if some news again comes in. Of course, you'll not be able to take any position on the futures and options side, but you can definitely take a position in cash. And if you're unable to close that position, of course, you go in for auction if it's a short trade.
Yeah, but I think from the looks of it, Navneet, it stays in the ban for the time being. Just looking at the quantum of positions that have been built already.
Just one more point, for the last 3 series, since the time SEBI has tightened the margin requirements, we've not seen stocks coming into the F&O ban. And Yes Bank, I think towards the end of November series, entered into the ban. And it's after a while, we are once again seeing stocks entering. And a stock like Yes Bank, which is still a nifty counter, it's quite surprising.
Yeah, it's just the trading pattern, which was a bit of a giveaway the last couple of days. Navneet spoke about it yesterday on Countdown as well, that just look at the market-wide position limit, and it certainly seems like this one was entering into the ban. 7% down in trade yesterday as well, futures price even lower. Thanks so much for putting that into perspective, Navneet. Watch out for Yes Bank, as also watch out for ICICI Bank. Completely converse the kind of momentum around it. It held an analyst meet, a first analyst meet after a decade yesterday, and the analyst community seems very impressed with what they saw and heard from the management, especially the fact that the private lender will continue to focus on profitability over market share. Right, Shefali?
Well, yes, absolutely right. That's the key strategy, that they are going to focus on profitable growth and core PPOP growth, which is a pre-provisioning operating profit growth across segments. And within the segments, they're actually focusing on getting more granular business. So even when you talk about the corporate banking or the wholesale banking, so their strategy has been to shed off the bulky or the concentrated accounts and getting more granular or smaller accounts. So some of the key themes that actually were very visible during the analyst meet yesterday were, in fact, one of the interesting things which one of the analysts wrote was that instead of the top management, the heads of various verticals gave the presentations for their own vertical. So that goes to show the focus and the depth of the management. And also one of the key themes that played out during the entire presentation was the digital-led growth. So across segments, their focus is to grow via various digital means, to data analytics and all of that. And also one of the important things that management pointed out was that there is a continuous improvement in the pricing power. So because of the lack of credit supply across segments, across industry, so the shift is actually happening towards the banks. We already knew that, but now it's clearly getting visible in the earnings of the banks, their strategy and what the management is telling us. And the bank didn't change its existing ROE guidance of 15% by June 2020. So that'll be a key number to look forward to. And because of this use of technology, one of the important things that will happen to their earnings is that their cost will actually come down. Their operating expenditure, the cost of acquiring the business, all that will keep coming down. And also the bank expects recent judgments to enable faster resolution of future NCLT cases. So obviously the reference was with regards to the SR Steel case. After that, all these banks have become very confident of more recoveries going forward. So a bit more details of the retail banking and the corporate banking. In the retail business, the bank is continuing to focus on selling products through its ecosystem, and the rising share of instant loans, which is helping in cutting costs. So one data point which has been put out, that digital now makes up 53% of personal loan originations versus about 5% in FY18. So that's a huge jump just in a span of 1.5 years. When it comes to corporate banking, so the bank has reduced concentration and improved quality of origination, of loan origination. And the corporates, another interesting part is that corporates themselves are moving towards banks offering, towards offering a comprehensive solution. So the corporates are coming, in the forefront themselves and then offering various solutions. And another thing that the bank, very interesting thing that the bank said is that it's the first time in history that the corporates are coming forth and saying that they want to do business with them, even if it means at higher expense. So that's a very interesting trend, and it's something interesting to look forward to as well, how it pans out across banks as well. And they're targeting the entire value chain of employees, customers, etc., from head to toe to enhance profitability. So when they're going first to get the business, the first approach is not to get the credit business, but to get the non-credit business to enter into an organization and then getting more business from them. So that's a key strategy that they are adopting when it comes to corporate banking. So that's that, and brokerages have reacted very favorably. UBS, for instance, has raised the target price to 620 versus 570 earlier, and they've maintained the buy rating. Nomura has raised the target price to 645 from 610 earlier, and they're also maintaining their buy rating. Morgan Stanley believes that ICICI is set to become a compounding machine, and they have a target price of 775.
Yeah, they have been bullish on ICICI Bank and they're continuously raising the prices. But I like that what I heard, Shefali. It'll be very interesting to see if the other banks also say the same thing, that corporates are coming forth and saying that even if the stable banks, that even if it means higher expense, we want to come out and do more business with you and get innovative products going. That would mean, well, maybe good for the corporates as well, but better fees for the banks.
Yes,
so
absolutely.
It'll be interesting to see
across
the banking landscape if that's happening or not. That's Shefali Malik with all the highlights of the ICICI Bank Analyst Day that was held yesterday. The centre is planning to review the current compensation cess and GST rates. This comes after collection has missed the targets for months now. That's prompted the Finance Ministry to write to states seeking their suggestions on a possible review. Nikunj Johri reports.
The government is planning a review of GST rates and compensation cess rates on various products in its effort to augment GST revenues. In a letter to state GST officials, the central government has sought suggestions from the state governments to increase GST revenues and see if GST rates and compensation cess rates can be increased on several products. This comes at a time when compensation to states has increased significantly and is unlikely to be met through the compensation cess fund, according to the letter. Remember, compensation cess is levied on sin or luxury products and is used to compensate states for any losses that they incur in first 5 years of GST's implementation. Remember, a few states had also raised concerns since they did not receive compensation for the month of August and September, and were facing financial stress because of not receiving the compensation that was due for the month of August and September. The government has also sought suggestions from the states to review if some of the items that are currently exempted under the GST regime can be looked into and GST can be levied on them, and has also sought suggestions for a review of the inverted duty structure, under which inputs are taxed at a higher rate than the finished product itself. Remember, the government is currently staring at a shortfall in GST revenues, and the gross GST revenues up to November have been 8.05 lakh crore rupees against the budgeted target of 12.17 lakh crore rupees for the current financial year.
Okay, that's Nikunj with that report. And the last piece on First Word today is on a stock that has rallied 40% this year to scale lifetime highs, and that's Tube Investments. Nikki is here to tell us what could be working for the company. Nikki, a bit of a late bloomer, but the last 3 or 4 odd months, it's really hit its straps and rallied significantly. What's happening in Tube Investments?
So I'm going to start off by giving you a little background of what the company is essentially. It's a Murugappa Group company with a market capitalization of around 9,000 odd crore. If you look at the diversified portfolio that it has, it's across bicycle, it's engineering, metal forgings. All of this is a part of substantial business of the company. And if you look at the company is actually a holding company of 5 subsidiaries put together. Back to a little bit of history of this company. How did it start? Was initially it was known as TI Financial Holdings. 2017, the group the unit got demerged into 2 entities, that is manufacturing and financial services. Financial services continued new as TI Financial Holdings, whereas Tube Investment in its current shape and form was formed. In that case, we had all the diversified units out there. Let's actually look into what are the factors which are essentially leading to this rally, or the sound fundamentals that are in place for the company. Let's look at the top line, where it's getting the diversified revenue streaming business from. So as I just mentioned, metal formed products, that as a percent of your total sales, that occupied to nearly 34% of the complete picture altogether. Engineering, that division occupies more than 40% place in your top line. In terms of cycle, it's also a bicycle manufacturer, 17% growth coming in from from there, and gears that form 6% of your overall sales pie put together. And the company is among the among the leading top 3 players in these segments. And apart from that, it also continues to enjoy a strong financial portfolio at this point of time. The risk profile seems to be pretty decent for this company. If you look at the debt to EBITDA ratio of the company, it's only improved from the time that we've seen 1.5 times that we've seen in FY19, and now it's come down to 0.5 times in the first half of the financial year. We've seen a strong amount of operational performance and the cash flow, which in turn has aided the debt to EBITDA ratio of the company. And also CRISIL goes on to say for the medium term, it expects that to remain healthy under the 2 times level, given that the cash flow generation is expected to continue at a steady pace for this company, and also because of the receding debt. JM Financial in the brokerage report has also said that they expect the company to be a debt-free company in a span of next 2 to 3 years, for that matter, for that maybe. Right now, the debt position, if you talk about that, it's a 250 to 80 crore kind of debt position that the company has. Apart from that, also if you look at the cash reserves of the company, the free cash flow situation, that's a pretty picture out there. Free cash flow have only risen from FY18. Cumulative free cash flows as of the first half of this financial year, they form 86% of a PAT. So clearly you can see the number out there, that's out for you. And if you look at the return ratio, or for that matter, return on capital employed, which is nothing but a ratio which equates the capital efficiency as compared to the improving profitability of the company. That has only increased and has stayed around that 22% kind of level if you look in the first half of the financial year. Apart from that, few other positives that are working in the favor of the company right now. It's going to be coming up with a capex plan, all of which will be funded internally. It belongs to Murugappa Group company, where you have seeing a strong franchisee. Apart from that, because of this, the ability to raise funds at attractive rate of interest also comes in. Apart from that, if we'll talk about the PBT margins of the company is actually over-delivered here. It has said that it's going to be meeting up the targets, achieving the targets of around 10 to 11% kind of PBT margin by FY 2023, but it's 9.5% at this point of time. They might just go ahead and revise that upwards anytime soon. But on the downside, 2 things which are technically not going well for the company is the bicycle division. That the little sluggish performance coming in from that division, and also since the majority of its revenue is still coming in from the automobile sector, because of which the cyclical performance comes in, that could be weighing down on the counter. But otherwise, net, if you look at the performance of the company, it's been a fairly steady picture. Operationally, it's done well. The capital employed, the ratios look pretty. It's going to be a debt-free company in the span of next 2 to 3 years. So going seems to be good right now for the company.
Okay, 2 to 3 quarters or 2 to 3 years?
2 to 3 years.
2 to 3 years.
Yes.
Okay, great. Nikki, thanks so much for putting that into perspective. That's with regards to Tube Investments and the possible reasons of why the stock could be active. But this was more a synopsis of what the company does in the first place and what's been working for it. 3 months, about 47% uptick into Tube Investments. That's all that we have on First Word today, though. Lots more lined up on Indian Open. We discuss markets and macros with Ashwini Agarwal of Ashmore Investment Management. Business outlook with Nitin Patel of Sadbhav Infrastructure in light of what the Maharashtra government has seemingly said. And talk about the impact of a delayed sugar cane crushing season in Maharashtra with Abhinash Verma of ISMA.